Hey everybody, this is John. Welcome to the free video. Let's do a deep dive here into Netflix. Getting a lot of questions on this. There is a beautiful squeeze setting up, and if we come back to the weekly chart, you can see that the nice little uptrend, we've had some consolidation. There is a big fire line there, but that doesn't mean we can't get to the fire line. And keep in mind, a squeeze can push it up through the fire line. But I do think that fire line is a good target. So the question is, do we buy some cheap out-of-the-money calls for tomorrow? And the answer to that is no, because tomorrow is monthly expiration, and what happens is the market makers deliberately keep things in check to suck all the premium out of the options. But what will commonly happen is after that, next week, it will make its pop. So think of it as there's a lid. Like, I'd be really surprised if tomorrow on Netflix it goes up $3 or $4. More than likely, it's going to trade sideways. So what do? So how do you set up something like this? Well, first of all, I'm looking to take advantage of the chop tomorrow by having sold the 145, 143 put credit spread for 74 cents, and with the idea that it could close at or above 145 tomorrow. And that's well within its expected move and all that kind of stuff. You can see the expected move is like $1.34. And then, of course, it could go either way, but it tends to kind of gravitate towards the higher open interest. And you can see here that while the 140 does have high open interest, it's well beyond the expected move of the stock. That would be a $4.39 move with an expected move of only $1.38, whereas the 145 is kind of right in that ballpark. So that makes sense. And the nice thing about the put spread, obviously, if it goes through 145 to 146 or 147, that's great. But most likely what I'm expecting is chop. Now you'll also notice that I've got some, so that expires tomorrow, right? You'll also notice I've got some positions that expire in 36 days and 43 days. Those are positions that I don't expect to make any money tomorrow. Because I'm expecting chop. So this position would absorb the chop, especially obviously if it gets to 145 or beyond. And then these would be ready to go next week when we get through monthly expiration. Okay, so that's a kind of a way to structure a trade like that. And then the other one we've been looking at is MOMO, and this is one where I bought some stock, bought some calls. Okay, and then sold some calls. This is kind of like a covered call. So what I did here is I've got 5,000 shares of stock and then 50 options. So on the 5,000 shares of stock, I sold 50 options that expire tomorrow, bringing in a credit of 50 cents. And on the 50 stock options, I sold another 50 calls at 55 cents. And in a perfect world, we'll actually close below $35 tomorrow. These expire worthless. I pocket that cash, and then we continue to rally next week into about 36. So that's the goal with this. So you might. So the question is, how do you find this stuff, and how do you set it up, and how do you determine what strategy to do? So I'm going to be talking about this kind of stuff at this free webinar on Tuesday, and I'll show you the results of this. And the idea with trades, and especially on a particular stock, is that, look, you can get a set, pick whatever setup you want. It's a squeeze, great. But a squeeze on Priceline is going to work different than a squeeze on Netflix, which is going to work different than a squeeze on, say, MOMO. Okay? And so what you want to do is identify in the general option strategy that works best with the particular stock that you are choosing to trade. Okay? Now you'll see right here that, and what I call these is kind of profit accelerators. Instead of like, oh, I got to squeeze, just buy a call. Well, on this stock, actually buying a call and selling a put credit spread works better. Or on this stock, buying a Delta 60 call works the best. Whereas on another stock, maybe buying a Delta 25 call works the best. It all depends on the stock. So far this year, as of this page being created, my account's up 98%. I'll check it. I'll show you where it is at the end of today. So here's my current account. Again, I always like to show, like, look, that's a clock. It's really, it's real. It's not a demo account. And then let me see if I can squeeze this window in here. Well, that doesn't help anything, does it? There we go. So overall P&L year to date is $133,000. We started the year at, I think it was like it's either $114,000 or $115,000. So now, so far this year, it's up over 100%. So these are all the trades we've been doing in the trading room, or that I've been doing in the trading room. So I'll scroll this out a little bit, you can see current positions. So, today I had Netflix was down money, MOMO made money, NVIDIA, Oracle, good earnings trade. So net added another $6,200 today. And so the question is each strategy is a little different. Okay, so the strategy on Oracle, a little different than the strategy on NVIDIA, a little different than the strategy on MOMO. Okay, so why? So first of all, you want to be able to say, okay, well, if I say delta 40 puts versus say delta 60 puts, what's the difference? And you can see, well, in this case, you got a 73% return on the 60s, but an 18% return on the 40s, okay, which is crazy. So you got to know what particular strategy works best with what particular stock. So I'll be talking about that, plus also some additional tools I found to essentially choose and find, say, a squeeze that's going to be 2 to potentially 3 times as strong as normal. Okay, and when you see that happen, it's like, oh my God, I really need to get into this. Or tools to measure statistically how trades have worked in the past with specific option series, so you can see looking forward how to apply that. So it's going to be a lot of fun. So again, you can go to simplertrading.com/rapid. This free webinar will be on Tuesday, March 21st at 7 o'clock Central. All right, looking forward to it. It's going to be fun, and I'll see you there.